Caesar's palace is not collapsing overnight. It is being restructured under pressure, one decision at a time. Why is this happening? What is being hidden behind the image of stability? And who is really benefiting from a system carrying nearly $12 billion in debt? There is a deeper risk emerging, not just financial strain, but a gradual erosion of standards that once defined the brand itself. This is no longer a question of decline in the future. The pressure is already here. The system is already adjusting. And the real question now is how long this model can hold before the experience itself begins to change in ways that cannot be reversed. If you want to understand how this structure really works, consider subscribing and follow the full investigation. Caesar's Palace officially opened on August 5, 1966, developed by J. Sarno with an initial investment of approximately $24 million. At the time, this was not just another casino project. It was a deliberate attempt to redefine what Las Vegas could represent. Sarno's vision was clear. He wanted to create an environment where every guest would feel like a Caesar. Not metaphorically, but structurally. The property was designed around excess, control, and spectacle. Roman-inspired architecture, expansive gaming floors, luxury suites, and high-end entertainment were not just features. They were part of a carefully engineered experience. During the late 1960s and 1970s, Caesars quickly established itself as one of the most recognizable properties on the Strip. It attracted high-profile performers, major boxing events, and a clientele that expected a level of prestige not commonly found elsewhere in Las Vegas at the time. For decades, Caesar's Palace held a dominant position. It was not reacting to the market. It was shaping it. But that position did not remain unchanged. Over time, ownership shifted, competition intensified, and the broader Las Vegas model evolved. New mega-resorts entered the market with larger capital investments, more advanced infrastructure, and continuous reinvention strategies. Today, Caesar's Palace still carries its historical identity. The architecture remains. The brand recognition remains. But the structure behind it has changed. What was once built as a controlled high-margin luxury environment is now operating within a system defined by financial obligations and market pressure. And that contrast between past positioning and present structure is where the real story begins. The structure behind Caesar's Palace today is no longer straightforward. It is layered, segmented, and driven by financial engineering rather than traditional ownership. The real estate is not owned by Caesars Entertainment. Since 2017, the land and physical assets have been owned by Vici Properties, a real estate investment trust created as part of Caesars' post-bankruptcy restructuring. Caesars Entertainment operates the property, but it does so under a long-term lease agreement. This is a classic sale-leaseback model. In practical terms, Caesars sold the real estate to Vici and then leased it back to continue operations. The lease is structured as a triple net lease, meaning Caesars is responsible not only for rent, but also for maintenance, insurance, and property taxes. The rent is not static. It includes escalator clauses, meaning payments increase over time, regardless of short-term business performance. This creates a fixed financial obligation that cannot be deferred. At the same time, Caesars carries approximately $12 billion in corporate debt as of 2025. This includes various tranches with staggered maturities, requiring ongoing refinancing and interest servicing. The critical mechanism here is simple but restrictive. Cash flow comes in from operations. But before it can be reinvested, a significant portion is immediately allocated to fixed obligations. Lease payments to Vici, interest payments to creditors. This reduces flexibility. And when flexibility declines, every operational decision becomes constrained by structure rather than strategy. In recent reporting periods, Caesars Entertainment has continued to generate substantial revenue, but the underlying performance shows signs of compression. For full year 2024, Caesars reported approximately $11.5 billion in net revenue, with adjusted EBITDA around $3.7 billion. On the surface, this reflects a relatively stable recovery compared to post-pandemic levels. However, growth has slowed. Year-over-year revenue increases have remained modest, while margins face increasing pressure. On the Las Vegas Strip segment specifically, occupancy rates have remained high, supported by steady visitor flow. According to data from the Las Vegas Convention and Visitors Authority, total visitor volume in 2024 exceeded 40 million, approaching pre-2020 levels. Harry Reid International Airport also reported continued passenger growth, reinforcing demand stability. But the composition of revenue is shifting. Higher room rates and premium pricing strategies have supported top-line figures, even as certain segments show softening demand. Gaming revenue growth has been uneven, while non-gaming segments such as entertainment and hospitality face higher operating costs. The result is a narrowing gap between revenue and actual profitability. From a distance, performance appears stable. But underneath, the system is working harder to maintain that stability. The pressure inside Caesars is not theoretical. It is embedded in fixed obligations that operate continuously, regardless of performance. The first layer is rent. Under the triple net lease with Vici Properties, Caesars must make recurring payments that increase over time through contractual escalators. These payments are non-negotiable and take priority over discretionary spending. The second layer is debt servicing. With nearly $12 billion in outstanding obligations, interest payments alone represent a constant drain on cash flow. Rising interest rate environments further increase refinancing risk as maturities approach. The third layer is capital expenditure. Properties like Caesars Palace require ongoing investment to maintain brand standards. Renovations, upgrades, and infrastructure improvements are not optional in a competitive Strip environment, but under financial constraint, these investments are often delayed or reduced. This creates operating leverage in reverse. Revenue must remain high just to maintain baseline obligations. Any fluctuation in demand immediately impacts available cash. Depreciation continues. Assets age. Service quality becomes harder to sustain at consistent levels. The structural weakness is not a single point failure. It is cumulative pressure. And the key signal is already visible. Not collapse, but constraint. A system still functioning, but increasingly optimized for short-term cash flow rather than long-term resilience. The pressure on Caesars Palace does not exist in isolation. It is unfolding within a Las Vegas market that is actively changing. According to the Las Vegas Convention and Visitors Authority, total visitation has largely recovered, exceeding 40 million visitors in 2024. Harry Reid International Airport continues to report strong passenger volumes, reinforcing that demand for Las Vegas has not disappeared. But the structure of that demand is shifting. The Las Vegas Strip is becoming increasingly dependent on higher-spending visitors, premium pricing, and event-driven traffic. Meanwhile, local and regional markets are showing signs of stabilization rather than growth. At the same time, competition is intensifying. Newer properties and recently renovated resorts are investing aggressively in upgraded rooms, entertainment experiences, and luxury positioning. This raises the baseline expectation across the Strip. There is also external pressure. Online gambling and digital betting platforms are expanding, capturing a portion of consumer spending that was historically concentrated in physical casinos. Overlaying all of this is a broader macroeconomic environment defined by higher interest rates, tighter consumer spending in certain segments, and increased operating costs. The market is not collapsing, but it is becoming more demanding. And in that environment, properties operating under structural financial pressure face a narrower margin for error. From the outside, Caesar's Palace still looks stable. Visitor numbers remain high. The Strip is active. Room rates have increased. Revenue, on paper, appears strong. But inside the structure, a different reality is unfolding. This is the central paradox. The property can generate billions in revenue and still operate under constraint. High occupancy does not eliminate pressure, it sustains it, because the system is not optimized for growth. It is optimized for obligation. Revenue flows in, but a large portion flows out immediately. Lease payments, interest, fixed costs that do not adjust with performance. This creates a situation where visible success masks underlying rigidity. The experience remains functional, but flexibility disappears. And that is where the long-term risk emerges. Because when a system loses flexibility, it loses its ability to adapt. And in a market that is constantly evolving, the inability to adapt becomes a structural weakness. Not visible at first, but increasingly difficult to reverse over time. What we are seeing at Caesar's Palace is not a sudden failure. It is a structural test. A test of whether a legacy brand can continue to operate at a high standard while carrying long-term financial obligations that do not adjust. The question is no longer whether the property can generate revenue. It clearly can. The question is whether that revenue is enough to sustain both the experience and the structure behind it at the same time. Because maintaining a luxury standard requires continuous investment, not just in construction, but in maintenance, staffing, and service consistency over time. And when a large portion of cash flow is already committed to fixed obligations, the margin for that investment becomes increasingly limited. So the issue is not visibility. The property still looks the same. The issue is sustainability. Can a system built on legacy continue to function under modern financial constraints without gradually changing what made it valuable in the first place? Or has that transformation already begun, quietly, beneath the surface? If you want to follow more deep investigations like this, consider subscribing and explore the next video on how financial structures are reshaping the Las Vegas Strip.